Let's do scripture. Go. All right. Gil, go ahead and read it. All right. Bottom line, just be nice. Have you ever noticed that nice people are usually happy? No. Oh, no. Yeah, nice guys finish last, but I think that's an exception to the rule. I think most people that are nice are also happy. And people that exhibit these qualities, they're usually not very happy, are they? Yeah. But I am nice. All right, I'm not going to make you take a quiz today. All right, Gil. Gil, who's praying? Aiden, good. Sounds perfect. Who art in heaven, hallowed be thy name. Thy kingdom come, thy will be done, on earth as it is in heaven. Give us this day our daily bread, and forgive us our trespasses, as we forgive those who trespass against us. And lead us not into temptation, but deliver us from evil. Amen. Hola! Ooh, okay, I'm going to give this to her. Thanks. Katie and I. It doesn't say to come by or anything. It just says, Klep. Klep. All right. It's up to you. Whatever you want. All right. Anybody have any idea why it is the Fed would want to lower interest rates to 4%? Benjamin. Do what? Repeat. Okay. I like that. They wanted to increase economic activity. So that includes investment. Should I give him a nickel for that? That's a pretty good answer. I should give him $100? Do what? Hold on. Okay. No, we should talk about this real quick, okay? Because Gabby is mentioning a very common mistake. Okay, I'll get that later. No. Shelby, see, you're also making a very common mistake, so I need to make sure y'all get this. There's two types of investment, right? In economics, when we simply say investment, we're talking about a business purchasing capital, okay? And when they purchase capital, they either have to forego earning interest with cash they have, or they have to go borrow the money to buy the capital. So in that instance, they would like to have lower interest rates, okay? Then the other type of investment, we would very specifically state financial investment. And that's where you take money and you want to go earn interest with it. So in that case, you want high interest, okay? Yeah, what we do when we're putting our money somewhere to earn interest, that's financial investment. We would like high interest rates. But if you're a business and you want to buy a new bulldozer or a truck, you want low interest rates. Yeah. All right, Gilligan.
So there's only one type of interest rate. It's just like it's different for whether you're a person or business.
Close enough. Yeah, we have real and nominal, but yeah. Depending on who you are, you want high or low interest rates. Okay? So how many of y'all read ahead and know the three ways that the Fed does this? Do you? That's one of them. That's two of them. That's 3 of them. Good. Yeah, in order to do this, they would lower the discount rate, lower the reserve requirement, or buy bonds. And buying bonds is open market operations. Missing my coffee. All right. So yeah, that was perfect. Do what? Go back? Oh, okay. These are the things we're actually learning today. So you'll get all this. You'll get more than you want in a few minutes. Okay? So you guys are going to understand today how the money market coordinates interest, okay? And there's a demand for money and there's a supply of money. Okay, we're mainly going to focus on the supply of money, and the Fed controls that. But we're also going to look, before we look at that, at how the demand for money can influence interest rates as well. And so when we start focusing on the supply, we're going to learn how it is that the Fed increases or decreases the money supply in order to influence economic activity. Everybody get that? That's what we're doing. You all have 2 homework assignments. 5.2a is just, it's reinforcing what we learned today. Okay? 5.2b is actually a preview of what we're doing next time. So it'll help you. Like, for example, Gabby, you're not going to be here? Okay. You definitely want to do that homework. Do what? Yeah. You bet. Oh, okay. So, yeah. Okay. So, okay. All right. We good? Okay. So let's review from last class. Anybody not here last time? All right. Cool. We'll play What's the Function again. Who didn't get to play last time? We had 6 volunteers last time. Courtney, you want to go? Do you need to review these things? You got them down? You know what? Some people need to review them. Why don't you tell them what they are? Is it, oh, a medium of exchange. Oh, so we did need to review them. Okay, tell us what unit of account means. Cool. And then the medium of exchange. Cool deal. And then the third one was store of value. All right, cool. You good with that? Did she do okay? Jessica, did she do okay? Okay, Jessica's next. You ready?
Wait.
That's my son. And I blew him up. No, that was my son. Yeah, I shot it. David estimates that his new car is now worth $0. How's he using money? You blinked again? Hold on. Ah, okay. So see, she did it. Jessica, you're next. Okay. The Walden family saves its pennies all year so that it can go on vacation to Buc-ee's. How are we using money? Store of value. Nice. Okay, see?
Thank God.
But I know Shelby would really like it, though. Be nice. I mean, your hand was up. I got to give you that. But then, I mean, Shelby really, maybe. Okay, if there's another one. You ready? Okay, Val sees her doctor finally, buys the medicine she's been needing. He advises her to move to Colorado. Medium of exchange. All right. On these. All right. Pass that back. Okay, guys, so let me explain a little bit about the money market real quick. We've actually looked at this before, haven't we? Okay, we looked at it one time when we were explaining the interest rate effect. But now we really need to know it. Okay, you're going to have to draw this graph. So we need to know that the y-axis is labeled interest rate. It's not real interest rate. Okay, it's actually nominal interest rate. So you could put nominal interest rate or just interest rate is fine. Okay? You've got the supply of money curve, which is completely vertical. Why is it vertical? It can change, but it doesn't change as a result of interest rates, right? Has no relationship to the interest rate. The supply of money isn't contingent on the interest rate. The interest rate is contingent on the supply of money. So it doesn't matter what interest rates are. The Fed determines how big this is. So that's why it's always vertical. The demand for money is what I want to spend a couple minutes on, because it is influenced by interest rates. There's two reasons we demand money, okay? One of them is to pay for things that we want. Okay, so now we're thinking of money as a medium of exchange, okay? So if we have a set amount of expenses each day or week or month, we're going to demand a certain quantity of money, okay? But then we also want money just to hold on to, okay? Like the money in my piggy bank right now. That's money I'm just holding as an asset. And that will fluctuate based on the interest rate, okay? So we're going to break those two types of demand for money down in a second. Can I move on?
So wait, so transaction rate is not functional interest rate?
It does not. The transaction demand for money does not fluctuate with the interest rate. However, the asset demand does. But that's something I'm about to explain in greater detail. I don't know how Ben just got that. It's like clicking with you now, isn't it? Good. All right. So let's look at, for a second, the transaction demand, okay? It's part of this curve here. But if we need $5 for lunch, how much money are you going to demand in order to pay for lunch? $5, okay? If, however, lunch goes up to $10, now how much money are you going to demand for lunch? $10. So if prices go up, then so does the demand for money. You guys follow that? When that happens, what happens to the interest rate? It goes up, okay? So interest rates are just the price that we pay for money, all right? What if the Fed wanted to put interest rates back down to where they were? So they're here now, and they want them to go back down. Okay, they can't change price levels. So what he said, right? He said increase the money supply. So they could do this, and then interest rates would be back where they were. Okay? So that's kind of what the Fed does. Okay, they're gonna do stuff like that. Oh yeah, the demand can go up and down like it just did. Okay? Well, the Fed can't control the demand. See, the demand for money is controlled by 320 million of us, and the Fed can't tell us what to do. Yeah, that's all they can do. It just lowers interest rates, see? Brings them back down. That's if they wanted to do that. Maybe they don't want to do that. It doesn't really matter. I'm just trying to make you realize that there's a demand for money that's influenced by prices, and then there's a supply of money that is influenced by the Fed. Okay? So let's roll and talk about the demand for money. Okay? So it's made up of a transaction demand and an asset demand, just like I mentioned. The transaction demand for money is actually a vertical curve. Okay, so it's completely vertical. Doesn't matter what interest rates are. We need, as a society, according to this graph, $100 billion in order to pay for our transactions. Okay, so when we think of transactions, we're talking about our monthly expenses. So if you have a mortgage payment, you've got electric bill, your gasoline that you got to pay for, car payments, things like that. Okay, you'll see how that works. And usually those things cost you about the same amount every month. Okay. It is. It's related to M1. In fact, we can think of it as the medium of exchange money. So whenever we use money as a medium of exchange, we're talking about the transaction demand. Okay. Ben mentioned this earlier. It is vertical, which means it's independent of interest rates. Okay. Doesn't matter what interest rates are. I still need, $1,000 for my house payment, $500 for a car payment. Okay, that always stays the same for me. Okay, and it's directly related to our nominal output or income, however you want to think of that. Nominal Y just means nominal GDP. So as GDP rises as a result of price level increases, then we need more money. Ben. Yes. So the interest rates don't affect these curves. but the curves affect the interest rate. Okay. All right, so you can think of this money, the money that we need for transactions, is the money we keep in our wallets or in our piggy bank or in our checking accounts. Scratch piggy bank, we don't use that to spend. It's our wallet and our checking account. Okay? Y'all cool with that? Okay. So then we add in the asset demand curve. Now this is where it kind of gets complicated, but I think you'll get it when I start talking about it. Okay? If you have, how many of y'all have a piggy bank at home? Okay? Or how many of y'all have a savings account that pays like really low interest? Okay? Those, we'll essentially call those the same things, all right? So if interest rates are super low like they are now, okay, let's say they're close to zero, that means we don't have a big incentive to put our money in some kind of, high interest bearing account, because there isn't such a thing, okay? So we don't mind just holding money. So according to this graph, when interest rates are zero, we're going to hold about $200 billion worth of money. Just going to hold it. We're going to save it in case we need it for something else later, okay? But if interest rates are super high, like 10%, do you have a better incentive of taking your money out of a piggy bank and putting it somewhere where it will actually earn 10%? Okay, in that case, we're not going to hold the money, we're going to put it somewhere. That's what this curve is representing. So when interest rates are zero, it's not worth your time to take your money out of your piggy bank and take it to the bank. When interest rates are high, like 10%, you have a greater incentive to take it out of the piggy bank and put it somewhere where it earns that interest. Y'all follow that? So when we're talking about asset demand, we're actually talking about money serving as a store of value. It's the demand we have for money just to hold. Okay, we're not spending it, we're not investing it, we're just holding it. Okay? So here's a summary of what I just said. So the asset demand curve is money that we don't need for transactions. Okay? We'll invest more of it at a higher interest rate. So now we're talking about financial investment, right, Shelby? So we got to make sure we understand that difference. We'll hold less because the opportunity cost increases. So when interest rates go higher, there's an opportunity cost of holding money. And so we're not going to hold it. We're going to put it somewhere. At lower interest rates, there is no opportunity cost of holding it, so we're more likely to hold it. So if we combine these two curves to get the total demand, all we're really going to do is scoot this one over by about 100 billion at each point. Does that make sense? So the total demand is still downward sloping because of the slope of the asset demand. It's just further to the right because of the transaction demand. Y'all cool with it? Yeah. If it makes you feel better as you're looking at this, we're not going to really spend a lot of time talking about the demand for money. Okay? We're mainly concerned with the supply. So transaction demand is independent of the interest rate. The asset demand varies inversely with the interest rate. All right, can I go? Cool. Get out of here. There we go. So let's analyze graphs, okay? This first one is the transaction demand. This one's the asset demand. And then this one over here, you've got the total demand for money combined with the supply of money. So here we go. Leslie. Hold on. No, let's do Jonathan, you're first. An increase in real or nominal GDP would shift the transaction demand curve to the right. So when nominal goes up, that means prices went up. So if prices go up, then we demand more money. Very good. Because real GDP takes the inflation component out of it. And so the reason we demand more money for transactions is when prices go higher. All right, now Leslie, at the equilibrium 5% interest rate, the amount of money demanded for transactions would be what? Well, the third graph is what tells us the equilibrium is at 5%, okay? But the transaction demand is the one I want you to look at. So we've got the 5% on both of these others. 100, you got it, okay? And the amount demanded as an asset would be how much? Also 100. So she's looking at this graph to get us 100 for transaction demand, and this one over here to tell us 100 for asset demand. Everybody cool? No, they vary. They're different. Yeah. Okay. So if the interest rate were 10% now, Luke, if the interest rates were 10%, the amount of money demanded for transactions would be how much? Still 100. That shows us that it doesn't matter what interest rates are, we still demand the same amount for transactions. All right, and what about as an asset? Now it's 0, because at 10%, way up here, the actual amount that we demand is going to be 0. Okay? Good deal. Stephanie, the asset demand curve slopes down because lower interest rates increase or decrease the cost of holding money. Decreases it. So as interest rates fall, I'm holding this money and it's not costing me anything. Interest rates are high. When I hold money, it costs me that high interest rate. That one wasn't that hard. Well, yours was a little bit tricky, and Jonathan's was a little bit tricky, but I didn't think the rest were that. I don't want to cheapen them. Okay. All right, so now we're going to move on to the Fed, okay? We're going to focus now on the supply of money. So the Fed controls the supply of money, and they do it with these 3 tools, okay? As we mentioned earlier, they'll use the discount rate. So it's important for us to understand what these terms mean, okay? The discount rate is just the interest rate that the Fed charges banks. So why would a bank borrow money from the Fed? Any ideas? Any money to survive? Yeah, sometimes they loan it out, right? Yeah. They do. They have a rule, and that's the reserve requirement. So let's table why a bank would borrow from the Fed for a second, and let's talk about the reserve requirement. Okay? The reserve requirement is a tool the Fed uses, and all it is it's the percentage of the demand deposit that must be held and not loaned out. Okay? So now let's think about it. If I put $100 in the bank, and my bank loans out 90 of it, okay, they're allowed to do that because the reserve requirement's 10%. So they have to hold my $10. Well, if I come in one day and I want my $100 back and the bank doesn't have it, what are they going to do? Now they could borrow it, and they can borrow it from the Fed at the discount rate. Okay? You guys follow me? Okay. If they lower the discount rate, it makes it easier for banks to borrow money, which then also makes it easier for them to loan money. So I'm going to show you in a little bit how it is that loans actually create money. Okay? And then the reserve requirement, if they lower that, okay, now my bank could loan out more money, right? Let me do a quick demonstration. I need to add a slide. Oh, give me just a second. Okay. I'm going to come back to this. So indulge me. Let's say I deposit $100. Oh, actually, let's back up. The money supply is equal to currency plus demand deposits. Everybody agree? Okay. If I have $100 cash, and I'm the only person in the economy, and I don't have a checking account, what's the money supply? 100. Okay. If I then take that $100 and I put it into the checking account, okay, I'm going to say that the currency no longer exists. Now it's still 100, right? All right. So let's pretend that the bank is allowed to loan out 90% of this. Okay? Shelby borrows it. Okay? I still have $100, at least on paper, or in some computer program somewhere. I still have $100 in my account. Everybody agree? But now Shelby has $90 cash. Right? What happened to the money supply when the bank loaned her money? It got bigger, right? Does that make sense? This is what we're doing next class. We're actually going to figure out how much the money supply grows by. But what I needed y'all to know before we start talking about the tools is that whenever a bank makes a loan, the money supply gets bigger. Okay, can y'all all agree with that? All right, cool. So going back to this. So if the Fed lowers the discount rate, it makes it easier for banks to borrow money. So potentially they could then loan out that same money that they borrow from the Fed. Okay? When the Fed lowers the reserve requirement, now instead of my bank only loaning $90 to Shelby, they could loan her $95. Make sense? If they raise the reserve requirement, maybe to 20%, now they can only loan Shelby $80. Okay? And then the third tool is buying and selling of bonds. That's also called open market operations. Okay. So open market operations is the third tool, but that's simply buying and selling of bonds. Okay? And a bond is just the government debt. So we're going to talk about those things all in detail in a minute. All right? Here's what I need y'all to understand. If there's a recession, the Fed is going to want to increase the money supply. And the way they increase the money supply would be to lower the discount rate, lower the reserve requirement, or buy bonds. Okay? So at this point, you don't have to understand why that all works. If you just write it down and you remember that, that's perfect. Yeah. In a recession, they would lower the discount rate, they would lower the reserve requirement, and they would buy bonds. Good deal? So if there's inflation, okay, if the Fed's trying to fix inflation, then they're going to make the money supply smaller. The way they make the money supply smaller would be to raise the discount rate, raise the reserve requirement, and then sell bonds. Okay? We're not technically in a recession, so why are they, yeah. Here's the thing. The economy is so fragile that the Fed has kept interest rates near zero for 5-6 years. Yeah, starting in 2015, they're going to start raising them. Nobody knows. No, there's going to be less money. They're going to make the money supply smaller in a couple of months. They are. Yeah, you could. You could earn more in your savings account. I thought you said you'd have more money in your savings account. Okay. Yeah, it'll still be really low. Yeah, I wouldn't count on retiring or anything. It's really going to be low still. Yeah, fractional reserve banking. Okay. Oh, 2 more terms we need to know. Okay. There's a thing called the prime interest rate. The prime interest rate is just the interest rate that banks charge their best customers. So that's something you'll need to be aware of. And then the federal funds target rate is the interest rate that banks charge each other. Okay? So the Fed is actually the lender of last resort. Okay? So that discount rate, they'll change the discount rate, but nobody really borrows from the Fed unless they have to. Okay? They actually borrow from each other. So my bank, if they loan out all my money and then I need it back, they'll actually borrow that from another bank. Huh? Where do they put it? Who put it? Oh yeah, they loaned it to other people. They gave it to Shelby. No, she borrowed it for a car or something. Yeah, she borrowed the money. Okay.
Like in savings accounts and stuff like that, why do they even have interest rates if they're so low? Like what's the point of it?
Well, the market rate is the determinant of it. But for example, if the economy was really strong and everybody wanted to borrow money to build factories and stuff, well, the bank's got to get that money from somewhere, and so they give you an incentive to put it in their bank by giving you a higher interest rate. Okay, so that's how it works. So your savings will go up as interest rates go up, and then the reason interest rates will go up is because more and more people are borrowing money. Okay, so it just coordinates it. All right, so let's roll. So let's talk about bonds first. What is a bond? Okay. Some of y'all may have a bond that Grandma gave you. Am I right? Yeah. So all it is, it's an instrument of debt. Okay. The Fed sells them. Actually, the Treasury Department sells them as well. Okay. But the Fed can buy and sell them. And all it is it's an IOU that says the holder of this is due to get back the face value when it matures because the government owes it to them. Okay. The point of that is this, okay, there's a couple things. Okay, why would anybody buy a bond? Okay? You're basically loaning money to the government. The reason you would buy a bond is because it pays a little bit higher interest than your savings account. Okay? So I don't know what they're paying right now. I'd have to look, but they're probably paying about 1.5% right now. Whereas your savings account is paying like 0.5%. Does that make sense? All right. Oh, no, you can cash it back in any time, but to get the full face value, you have to wait until it matures. Okay? You can get your money back any time. You just don't get the full amount, like with the interest and everything, until it's matured. Well, if it's like a 3-year bond, then what they'll do is, there's different types, but let's assume this is the one that Grandma gave you. Okay? If Grandma gives you a $100 bond, it probably really only cost her about $25. But in 20 years, the government will say, I'll give you 100 for it. So that tacks on all the interest throughout all those years.
What if the government crashes?
Well, there's only one government in the entire world that has never defaulted on debt. Guess which one it is? It's us. So that's the other reason people would buy a bond. It's super safe. Okay? So people will buy a bond for the slightly higher interest rate and because it's a safe investment where they're not going to lose their money. Yes, ma'am? No. Well, the face value would be using it as a unit of account, but the fact that people would put their money in bonds is store of value.
Oh, that's right.
Okay. Cool deal. So let's talk a little bit more about open market operations. We know what a bond is. Okay? This is the tool the Fed uses most. Okay, this is their go-to tool. All right? No matter what, they're always going to go with bonds. Okay? They are going to buy and sell between $60 and $70 billion of these every day. Okay? If they want the money supply to get bigger, they're going to buy more bonds than they sell. And if they want the money supply to get smaller, they're going to sell more bonds than they buy. During the Great Recession, they had a program where they bought $85 billion worth of bonds per month, more than they sold. So they're adding $85 billion to the money supply every single month, and they did that for several years. Let me show you how that works. I've got bonds and I've got dollars here. Okay? Anybody good at math? Oh, Z, good. Anybody good at math and focusing on events? Now let's give Z a chance. Z, these are money. Okay? Okay, good. So watch what happens. If I'm giving Yanni $100. You really got to pay attention. I'm giving Leslie $100, and I'm giving Grace $100. Sorry. I'll give Jonathan $100 too. Okay. So if that's all the money in the world, can you tell us what the money supply is right now? Mm-hmm. Yeah. How much money exists in our economy right now? Huh? 400. Okay. Y'all get that? Okay. I'm the Fed, and I'm going to sell Leslie a bond, and I'm going to take her 100. What just happened to the money supply? It what? It didn't increase. Yeah, see, when the Fed gets this $100 from Leslie, they're actually going to go burn it. It's no longer part of the money supply. Okay? So how much is the money supply now? It's got 100 there, 100 there, and 100 there. 300, okay? So when the Fed sells a bond, okay, I'm taking Grace's 100 now, what happened to the money supply? Okay, it got smaller, right? So selling starts with an S, smaller starts with an S. So if they sell bonds, what happens to the money supply? It gets smaller, it decreases, good. Now watch this. I'm the Fed, and now I'm going to buy Leslie's bond. What happened to the money supply, Z? That's right. And then, okay, so we're good? Shelby, you get it? Yeah, when I'm going to buy Grace's bond back. What happened to the money supply? It got bigger. So buying starts with a B. Everybody agree with that? And bigger starts with a B. Everybody agree with that? All right, cool. Olive, do you have a pregunta? No, you can sell your bond at any time. It doesn't have to mature. Okay. Maybe I was keeping, maybe I had $1,000 in bonds because it paid a slightly higher interest rate. But then I crashed my car and I got $1,000 deductible. Well, where am I going to get $1,000? Oh, I know, I got these bonds. I'll just sell them. So I'll cash them back in, get my money, and fix them. Yeah, let's pretend it's the face value and that they actually pay you interest every year. It's like that. So I forego the interest I could have earned, and I cash it out, and I go fix my car. You'll get whatever interest accrued from the time you owned it. All right, yes, ma'am. Yeah, so, well, it's as easy as what I just demonstrated, okay? So if we just had money in our pockets and that was it, when the Fed buys a bond back from Yanni, the Fed gives him $100, and now the money supply is bigger. I mean, it's just as simple as that. Mm-hmm. Yeah. So the point here is that, yeah, the Fed has to buy back the bonds whenever somebody wants to give it back, right? Well, if they want the money supply to get bigger, they'll keep buying all those bonds, but they won't sell as many, okay? They'll basically lower the interest rate enough to where people don't want to buy them, so the Fed won't be selling them. And then if they want the money supply to get smaller, they're going to sell a bunch of bonds, and they won't buy back as many. Okay? So it just works like that. So here's how it works, okay? This might help explain that question to you a little better, Kelly. All right, so when the Fed buys bonds from the public, that's us, okay? We put that money in our bank. Make sense? Then the bank loans it out to others. And there's just this whole cycle where the money supply just gets bigger and bigger every time a loan is made. Okay? When the Fed sells bonds, the public takes money out of their bank account, okay, gives it to the Fed. The Fed basically takes it out of circulation where it's no longer part of the money supply. Okay? They probably burn it or, shred it, whatever. Okay? So that's how bonds work. Okay? Selling and buying bonds changes the money supply like that. Next tool, reserve requirement. Okay, if y'all agree that when a bank makes a loan, the money supply gets bigger, then you'll understand how this works. Okay, this is the most powerful tool the Fed has. It's also the least used. So if you equate it to the most powerful weapon we have, the nuclear bomb, that's what this is. Okay, it's so powerful that it's never used. So. Right now, the reserve requirement's about 10%. So my $100, the bank can loan out 90 of it. If the reserve requirement was raised to 20%, then my bank could only loan out 80. So that makes the money supply smaller. Ben, question?
How would it be such a big control? Because why only 30% comes to the banks or members of the Federal Reserve System? Where they're trying to have control of all the banks.
It's all of them. Yeah, even the ones that aren't members, they're still regulated by the Fed. So they still have to do this. All right? You guys cool with that? This is the most powerful tool, so it's the least used. Okay? Okay, so let's go back for a second. Let's think. Open market operations, that's the tool they go to most often. Okay? That's the one they use every day. Reserve requirement, they don't use. Okay? They hardly ever change the reserve requirement. Does that make sense? Okay, because it's too powerful. The discount rate, here's its interesting little factoid. The discount rate is used all the time, but it doesn't do much. Okay? It's mostly symbolic. So if you remember that the Federal Reserve is the last resort for lending, then you'll understand why it is this one doesn't really do much. So if your bank needs money, they would have to be in really, really, really bad shape to go to the Fed to get it. Okay? They want to try to borrow money from other banks when they can. So why does the Fed even use this? It sends signals. Okay, if they lower the discount rate, then it sends signals to all the markets that all the interest rates are going to be lowered because they're going to increase the money supply. Okay, so that's why this is used. So in time of an emergency, the Fed will meet and they'll lower the discount rate. And it just tells everybody, don't worry, the Fed is taking care of it. Okay? So open market operations is the most used, reserve requirements the least used, and the discount rate is largely symbolic. So can we roll? All right. So again, the three tools. Okay. In this economy, can you tell that it's a recession? Okay. So if the Fed wants to increase economic activity, they need to lower the interest rates, right? Because now we're talking about investment in capital. Lower interest rates increases investment. Okay. So if they want to do this, they should lower the discount rate, lower the reserve requirement, or buy bonds. Which is the one thing they're actually going to do? They're going to buy bonds. Okay. They'll lower the discount rate, but the way they achieve their goal is really by buying bonds. Okay. And then if they're dealing with this economy over here, where there's some inflation, they want to try to bring aggregate demand back, and so they're going to raise the discount rate, raise the reserve requirement, or sell bonds. And the thing they're really going to do is sell bonds. Okay? Now, like I told you a little while ago, for today, it might just be that you just have to memorize what these things are. Okay? Next class, I'm going to show you how the money supply actually gets bigger. And you're going to also learn by how much it can get bigger. Okay? We're going to do some math. Everybody cool? Okay. So let's talk about, several of y'all asked a question, can you sell a bond before it matures, right? Didn't y'all ask that? This is how people really make money with bonds, okay? The interest rate on them is actually pretty low, okay, 1 to 2% right now, not a whole lot. So how would people make money with bonds? They buy bonds, they'll hold them, and then they'll sell them because there's a secondary market for bonds, okay? You don't have to sell your bond to the Fed. If you hold a bond, you could sell it to another individual. So if you look at this, as an example, suppose bonds are paying 8%. I buy a $1,000 bond. It's going to pay me $80 every year. Do y'all follow that? Okay, 8% of 1,000 is 80. So every year I hold that bond, I'm going to earn $80. Cool? All right, later on, interest rates fall. So now, if Sydney wants to buy a bond, and she wants to earn $80 a year, she's going to have to buy a bond that costs $1,333. Everybody get that? Okay. Sydney could buy my bond. If she wants to earn $80 a year, she could just buy my bond from me. Am I going to sell it to her for $1,000? No, because for her to earn $80 on any bond that's brand new, she'd have to pay $1,333. So how much could I sell my bond for? Yeah. I could sell it just $1 cheaper than a new one, and I'd make money and she'd make more money. I mean, I'd make more money, but she'd make more than she could on the other one. You guys get that? It's sort of like that win-win. We could split the difference. I could sell it to her for $1,200. She'd still be better off. Okay? On the other hand, if interest rates rise, now a brand new bond to pay $80, you only need an $800 bond. So guess what happened to the value of my bond? It went down. Okay? If I wait till it matures, I can get my $1,000 back from the Fed. If I want to sell it right now, I'm going to have to sell it at a discount. Okay? So y'all good with that? It makes a little bit of sense? Okay. So this is what I need y'all to know. Okay? Next class, I'm going to have you draw graphs. We're going to have, we're going to take a little daily quiz next class where you have to do this. Okay? What? Huh? Make what up? Yeah, if you want. I always put X because it's just so inconvenient for people to come in for those. But if you want to, yeah. Okay. All right, so here we have an economy. Do y'all see the economy down here, the bottom? Okay. So what's going on in this economy, Marcella? They're in a recession. So do y'all remember this lady? That's Janet Yellen, yeah. It's your girl Janet. And Janet's asking Marcella a question. What open market operation should the Fed use to jumpstart this economy? Okay, back it up. Let's see what you wrote on your notes. You should write in your notes somewhere that in a recession, they should buy bonds. Okay? It does. So watch what happens. This is why we do this. Okay? If the Fed buys bonds, you just said the money supply increases, right? Okay, cool. So the money supply is now increased. What happened to the interest rate? It went down, okay? Now that's important because if you look at over here, okay, this is a typical business's investment demand curve, okay? When interest rates were 10%, they're willing to buy this much capital. But when interest rates are 8%, how much capital are they going to buy? They'll buy more, right? So when the Fed decreases the interest rates by increasing the money supply, there's going to be an increase in investment, okay? Does that make sense? No? Okay. We talked about this at the very beginning. There's two types of investment, okay? Capital investment, in which case a business has to borrow money in order to buy their new truck or their new factory, right? Are they more likely to borrow money when interest rates are 10% or 8%? Okay. So when interest rates go down to 8%, they're going to buy more trucks, equipment, factories, right? Those things are part of the aggregate demand curve. So if they're buying more of those things, what happens to the aggregate demand curve? It goes up, right? Okay, here's the other thing. Going back to Unit 2, when these interest rates fall, what happens to the value of the dollar? It depreciates because now we're switching gears and we're talking about financial investors. So financial investors in other countries, they see our interest rates lower. That means they don't want to put their money in our banks. And if they're not putting their money in our banks, then they're not going to come get our dollars from Gabby, which means the dollar depreciates. How does that affect exports? Okay. Exports are going to increase. Consumption, interest-sensitive consumption is going to increase. And interest-sensitive investment is going to increase. Yes, ma'am. Okay, so remember there's two types of investment. Okay. There's the purchase of capital, and then there's just putting your money somewhere where it earns interest. Okay. If you're a business owner, you can make more money by improving your business. Okay, you earn profit. Or you could put whatever money you have in a bank and earn interest. If interest rates are lower, there's more incentive to buy the capital so that you can then make a profit. Because you can earn more profit than you can interest. Or if you don't have any money, it's easier for you to borrow the money to then put into your business to make profits. Then on the other side is the financial investor. Let's pretend I have $1 million. And I'm a horrible business person, so I'm not going to start a business with my $1 million. Instead, I want to put it in a bank where it earns interest. Okay? When interest rates are lower in one country, I'm not going to put my money in that country. I'm going to put it in the country that has the higher interest rates. All right, let's back up. There's two types of interest. Two types of investment. What are they? Okay. So capital investment is what? Okay. And in order for you to buy equipment, let's just make it simple. You have to borrow money to buy that equipment. So if you're going to borrow money to buy equipment, do you want to do it at a 10% interest rate or an 8% interest rate? Okay. So at the 10% rate, you're not going to buy as much capital. But at the 8% rate, you're going to buy more capital, right? It's cheaper. Remember in class one day we looked at how payments change when interest rates change? Okay? And like if you're spending $200,000 and the interest rate's 8%, your payment's like $1,500 a month. Whereas if the interest rate drops to 4%, your payment's only like $800 a month. That's a big difference, right? So that's why interest rates affect the amount of investment. Mm-hmm. Yep. Then the financial investor wants the high rate, right? Okay. So those foreign financial investors, when they see our rates drop, they're not going to put their money in U.S. banks, so they don't need to buy dollars, so the dollar depreciates. So then the combination of all of that, okay, a depreciated dollar, and lower interest rates are going to increase consumption, investment, and exports. Okay? Those three things are a huge part of the aggregate demand curve. So when that happens, the aggregate demand curve shifts to the right, and now we just fix the problem. Does that make sense, guys? Okay. Did we clear up the two types of investment? Because I did notice on your last test a lot of y'all made that mistake, and so it's really important that we know the difference. Kelly, you good? All right, awesome. Courtney. All right, so it's, do you ever watch car commercials? Okay. One of the big things to get you to buy a car is they're always talking about 0% interest for 60 months. That's a big incentive. I mean, for me to go buy a car, if interest rates are low, that's good. That's why consumption goes up. All right? Or the stupid furniture commercials. Have y'all seen those where you could buy a couch and you don't, it's like 0 interest until 2020? It's ridiculous. Yeah.
You work on like a broker test because the U.S. gets a dollar because it's all appreciates. Do you want us to think in terms of the U.S. consumption and not foreign consumption of organs? Because honestly, no, appreciates foreign consumption.
Yeah, that's whenever you get a question about the value of the dollar, you can always expect a follow-up question of how that affects exports. Mm-hmm. The interest rate lower is what affects consumption. Okay, consumption's domestic. The interest rates being lower is what affects investment, because that's also domestic. But the lower interest rates affect the value of the dollar as well. All right, can I roll? All right. Shelby, Janet Yellen has a different problem. What's going on in this economy? Okay, so she's asking you, what should she do? Buy or sell bonds? Sell bonds, good. So when she sells bonds, this curve is going to shift which way? Good. So there's going to be a decrease in the money supply. When that happens, what happens to the interest rate? It went up, right? Okay. So when the interest rates rise, what happens to the amount of investment going on? Down. Okay, good. Because now, to buy that robot, it's going to cost more than it did when it was 6% interest. Okay? On the other hand, what if you're a foreign financial investor? You're some dude from Canada, and now interest rates are higher in the U.S. You're going to put your money here. So first you go visit Gabby, right? What happens to the value of the dollar? Perfect. Okay? And when the dollar appreciates, and then we combine it with lower interest rates, what happens to consumption, investment, and exports? Good. So they decrease. And when those decrease, what happens to this aggregate demand curve? I think we made a breakthrough. Yeah, give her a round. She deserves a nickel for that. I'm actually very impressed. Can you do that on a test? If you can do that on a test, you'll get 100 on the next test. That's perfect. Yeah, this is what it all boils down to. And if you think about it, wasn't our last test similar to this, except we were using fiscal policy instead of monetary? Okay. I don't want to think about it either. All right. Shh. They're going to hurt you. They're going to hurt you, Ben. All right. So guys, there's this rule, okay? The Fed sometimes just makes this way too, I don't want to say way too simple. They make it actually very simple, okay? The Fed believes, or at least most of them, okay, over the last 20, 30 years, this is kind of what they've done. They've kind of made the decision that they really, really, really just want to focus on inflation, okay? And they believe, and I think this is probably pretty true, they believe that if the inflation rate remains 2%, then unemployment will be good and economic growth will be good, okay? Whenever inflation goes above 2%, at that point in time, you worry about inflation, the economy is too strong, and unemployment's too low. If inflation's below 2%, there's a very good chance that the economy's not growing and you have high unemployment. So they really do focus things on the inflation rate. So if inflation is 2.5%, what are they going to do to the money supply? What do you think? Shrink it. So you got this. And if the inflation rate's only 1%, what are they going to do to the money supply? Increase it. Okay? And they figure the rest of the stuff will take care of itself. So this is called core inflation targeting. I I don't think I put it on your test, but it's still something interesting. Okay. Yeah, you can almost predict what the Fed is going to do. If inflation is low, they're going to shrink the money. They're going to increase the money supply, and if inflation's high, they're going to shrink it. All right. Y'all feel good? By the way, even though this is actually very interesting. I don't know how this is possible, but the money supply is about 3 times what it was 10 years ago, right? I mean, they've grown it by 300+%. But inflation on the last measure was only 1.8%. Isn't that crazy? So they're continuing their bond buying program at least until the first quarter of next year. When they start to see inflation tick up, guess what they're going to do? They're going to stop buying the bonds. They're going to start selling them. Okay. All right. Shelby, this is really where you're going to shine. Okay. This is what your test will look like, the free response part. Okay. So what I want y'all to do is we're going to spend just like 10 minutes where y'all are going to answer these questions. Okay. And then we're going to go over the questions as we go. By the way, this is a tricky question, except for one thing. If you truly read it and you answer what they're asking you to do, it's not tricky. Okay? So it says here, assume that declining stock market prices in the U.S. cause many U.S. financial investors to sell their stocks and increase their money holdings. So far, we understand? Here's what they want you to do. They want you to draw a correctly labeled graph of the money market and show the impact of the financial investors' decisions or actions on each of the following. So they want you to show what happens to the demand for money, and then they want you to show what happens to the nominal interest rate. Dude, let's go back and look. Okay? So that's what I want y'all to do real fast. I'll give you a minute to do this, and then we'll go over it. And then we'll answer the next part of the question. Are we okay? So are y'all good to go over this part? Sydney? You ready? Okay, I'm going to wait on Sydney. This is just practice. If you do it wrong, it's okay. I'm going to mention a couple other things while some of y'all are still working. Even if you do this part wrong, if you base the rest of the question on your wrong answer, you still get most of the credit. Okay? So there's still internal consistency. All right. Sydney, I'm just going to go over it. Whoa. Kelly? Okay. So the first part of the question said to draw the graph, right? This is what the graph should look like. So far, are we in good shape? All right. What happens to the demand for money? It increases. Okay? Why does it increase? So these financial investors had their wealth tied to stock, right? But then, because they weren't getting a good return, think interest, okay, they decided they should just hold the money. So the asset demand for money increased, meaning the whole curve shifted to the right. How many of y'all got an increase in demand? Okay, that's pretty good. Even if you didn't, though, okay, you'll see that the points aren't going to be that big a deal. For, you know, if you, let's say, how many of y'all increase the supply? Okay, all right. See, that's technically wrong, but you can still move on from that, okay? So here's how it was graded. The really explicit answer, which you don't even need to put this much to get credit, but this helps explain it. In an effort to preserve wealth, investors sell off stocks when market prices begin to decline. These new money holdings will increase the asset demand for money. In the volatile market, investors will hold more money while determining future needs. So you get 1 point for the correct graph, and then 1 point for shifting the demand curve up. Everybody follow that? Okay. Next, you get 1 point for saying that the interest rate increases. So that was the second part of this question. Okay? Everybody cool? You ready for the next part? Okay, I wait. I like it when we have a full day. We're actually going to finish. So, Gil, you learn anything? Okay, good. All right, I'm moving on. Okay, part B. Due to the decline in wealth caused by the change in stock prices, the general price level in the U.S. falls relative to the price level in Japan, a trading partner. Use a correctly labeled graph of the foreign exchange market for the U.S. dollar to show the impact of the change in relative price levels on each of the following. So this answer here is not dependent upon what you did in the first part. So we're ignoring the first part for now, and we're only answering this question based on the parameters given, okay? And the key there is that the price level has fallen, okay? So y'all do that. You gotta tell us what happens to the demand for the dollar and the price of the dollar. That's a yen. So you use a correctly labeled graph for the foreign exchange market for the dollar, and then show what happens to the demand and the price. Oh, it's close. You remind me of that commercial for the Surface. They're comparing it to the Mac. And they say, oh, and it can be a tablet. And so they, oh, I can do that too. And they throw down the iPad. And they said, oh, but I can write on it. And they throws down a notepad. I said, I can write on it too. I like it. I do too. You ready to see the answers? Here's the answer. All right, so the first part is you draw the graph for the dollar. How's the dollar priced? The yen price of the dollar, or yens per dollar, okay? You got a demand curve, a supply curve. Everybody good? Did y'all do that right? That's good. Half the battle's just drawing the graphs. Okay? The demand for the dollar is going to increase. Why does it increase? Because price level's lower here, okay? So you can get more goods here for the same price than you can in Japan. So the Japanese are going to buy more of our stuff. Okay, price of the dollar goes up. So here's how the points were awarded. The explanation: this decrease in price level will cause the Japanese to want to buy more U.S. goods, increasing the demand for the dollar. So you get 1 point for the graph, and then 1 point for showing an increase in demand for the dollar. You'll do okay? Cool. Okay, next, the explanation. You get 1 point for saying the yen price of the dollar increased. And here's some more explanation. Lower prices in the U.S. would cause an increase in demand for the dollar, resulting in the Japanese having to pay more for American goods. Therefore, the yen would depreciate as the price of the dollar has increased and the dollar has appreciated. That's more explanation than you need, okay? You can put arrows for the price change, but sometimes you need a couple of words to explain why, okay? So the fact that U.S. goods become less expensive means Japanese people buy more U.S. goods. That's a good enough explanation. Okay. You all ready for the next one? Kelly, you want me to wait? Okay. Yes, you may. So, Grace, what you gonna do with that pie? Come on time. Oh. Oh, because of the tea thing. I bet you they didn't count you tardy. I bet they didn't. I bet you they didn't. Yeah, I'm sorry. Kelly, can I go? All right. Notice this is a long free response question. So it's like it's going and going and going. So the next part C, how will the change in the price of the dollar you indicated in part B affect net exports of the U.S.? Explain. So in this one, if you actually cause the dollar to depreciate, your answer will be different and you'll get credit. Okay? So it's all based upon your answer in part B. Internal consistency. Gil, you have a question? Cool. You're going to miss what's called the money multiplier. No, you learned the spending multiplier and the tax multiplier, but now we're going to learn about the money multiplier. Mm-hmm. Minor. I'll give you notice for major. Yeah, we'll have another quiz then, but it won't be a major. Your major quiz will be Friday. Mm-hmm. You'll be okay. Kelly, can I go? Okay. Oh, Courtney. It's the Friday before we go to Thanksgiving. All right, let's go through this real quick. Let's have Katie Nye. How will the change in the price of the dollar you indicated in Part B2 affect net exports? Okay. So the answer goes like this. The appreciated dollar would cause American goods to now be more expensive for Japan, and Japan's goods to be less expensive for Americans. Therefore, we would export less, import more. Perfect. Full credit. 1 point. Okay, and then 1 point for saying U.S. goods are relatively more expensive. So you get both points there. Perfect. Good job. Okay. Part D, using a correctly labeled graph of the ADAS, show how the change in net exports in Part C will affect each of the following in the short run. So again, this one's dependent upon what you did in Part C. You ready to review it? Yep. All right. Olive. Let me draw. I'm drawing the graph first. So y'all's graph should look like this: price level, real GDP, AS curve, AD curve, long run aggregate supply curve. Cool. Olive, what's going to happen to the aggregate demand? It's going to go down. Perfect. Okay. So since aggregate demand is made up of consumption, investment, government spending, and net exports, when the exports fall, the AD curve shifts left. Cool. And then just showing us what happens to price level and income or output. You got it. Price level and GDP go down. So how do you get points? The explanation goes like this. As can be seen on the graph, the decrease in net exports would decrease aggregate demand. The decrease in aggregate demand would decrease output to Y2 and price level to PL2. You get 1 point for the graph, 1 point for decreasing aggregate demand, and 1 point for price level and income decreasing. Cool? Okay. This was a real free response question from 2007. Yeah, I put my class through this. Yeah.
So would you end up taking a test next semester?
Uh-huh.
We don't.
You don't have to. Like,
The
you don't
AP
have
test,
to
right?
see.
Yeah.
Because sometimes it just a step doesn't go through.
Yeah.
I mean, yeah.
Hey, I think y'all are, honestly, to be perfectly honest with you, you guys are blessed to be able to get credit, because when you go to the spring and you try to remember all this, it's hard.
I always get levels when you had to pay not only like $3 or $500 for the class, but you also had to pay for the test. Like you didn't get credit just for being in class.
Yeah.
Like you could pay for the class and go through it, but you
Right.
still wouldn't get credit until you took the exam.
Gotcha.
Isn't that crazy?
It's crazy. Cray. All right, part E. Given your answer to part D, what will happen to unemployment in the short run? This is the last part. So, Olive, you just answered this real fast. What happens to unemployment now? Up. Okay. So the answer to part E, and by the way, you get 1 point for saying there's going to be an increase in unemployment. You have to explain why, and the reason is this: if there's less output, there's less need for labor. Okay. So the decrease in net exports in Part D will result in a decrease in AD and output, which would increase unemployment in the short run. Cool deal? I think y'all did great. We can answer these questions and keep going if you want. You want them? Wait a minute. Why? You gotta trust yourself. Okay. Yeah, let's just rapid fire these real fast. That way I make sure, because some of these are on your homework, and that way your homework will go easier. Okay. All right. So let's just start with Jonathan. The transaction demand for money is most closely related to money functioning as. I'm asking him. Okay, he said yeah. So this is supposed to be over there, so yeah, it's medium of exchange. Okay. Very good. Then Benjamin, the asset demand for money is most closely related to money functioning as store of value. Good. Okay. Courtney, if nominal GDP is 900 billion and on the average each dollar is spent 3 times per year, then the amount of money demanded for transaction purposes would be. Good. I didn't specifically teach you that, did I? No, I didn't. But you could understand it. Okay? Because GDP is the purchase of things that we produce, right? And so if we're purchasing $900 billion worth of stuff, but we only have $300 billion worth of money, then we're spending those things 3 times. Okay? Shane, the transaction demand will shift to the right as a result of an increase in nominal GDP. And so the transaction demand will shift to the left as a result of a decrease in nominal GDP. Good. All right, Jonathan, the asset demand for money varies directly or inversely with the interest rate? It's inverse. That's why it's downward sloping. Perfect. Okay, Leslie, the basic policy-making body in the American banking system is the... Perfect. Yeah, there's no such thing as the Council of Economists. Okay, Gil, the Fed was created what year? Good. Okay, we didn't talk about number 9. That's important. Yeah. Number 9 is actually completely unimportant, okay? But let me just give you the answer. So in the 1980s, banks were deregulated. So all the banks could do the exact same things. You did? Okay. So y'all really don't need to worry about number 9. Okay, number 10. Who's up next? Aiden. The transaction demand for money is shown by which of those graphs? Say it again. I didn't hear it. Now say it differently. Say it like a different word. 1. Okay. Yeah, y'all need to make sure y'all know that the transaction demand curve is vertical. Okay? All right, cool. Olive, the asset demand for money is shown by which of those? D2, good. And then the total demand for money is shown by Sid? D3, perfect. All right, Grace, if each dollar held for transaction purposes is spent 4 times per year, nominal GDP would be how much? Well, it's 2 times 4, 800. Okay, that's Courtney's question from a little while ago. You remember it? Okay, so this is the money we need to buy the things we buy, right? So if we're buying things 4 times over, then 200 times 4 will give us our GDP. Okay? If the Fed increased the money supply curve would shift which direction? Z. If the Fed increases the money supply curve would shift which way? Okay, perfect. So when it shifts right over here, what happens to the interest rate? Okay, it was here, and now it's here. Thank you. Okay. Last page. Okay. Why don't you just take notes?
Because I don't have these tutors write down. I don't think
All right, last page. Luke, the Fed or the Council of Economic Advisors hold the deposits of commercial banks, provides for the collection of checks, acts as a fiscal agent of the federal government, and exercises supervisory power over member banks. Fed. Okay. Jessica, in the U.S. economy, it's the President, the Congress, or the Fed who controls the money supply? The Fed. And by the way, we should talk a little bit about this. Why wouldn't you want the President or the Congress doing it? Yeah, they'll be partisan about it. They'll be too political. Okay? Gabby, the 12 Fed banks are privately or publicly owned? But publicly controlled. Good. And Steffi, last one. Oh, this is the term thrift. Okay? Includes savings and loans, credit unions, and what do you think? The savings banks. So I should, you know what? I think I actually did put a question about this on your test, so I should actually talk about it really fast, okay? No, I don't want to do that. I'm gonna explain it to you. So do you guys remember the movie It's a Wonderful Life? Okay, if you've seen it at Christmas time. If you haven't, that's okay. There were 2 banks in the town. Do y'all remember that? There was the Savings and Loan. That was the good guy's bank. And then Old Man Potter's bank was the National Bank. Okay? A commercial bank back in those days, that was Old Man Potter's bank, could basically, you could have a checking account there, and if you needed to get a loan for a business, you would go there. But if you had a savings account, you couldn't put it at the commercial bank, you had to put it at the Savings and Loan. And if you needed a mortgage loan, you wouldn't go to the commercial bank, you'd have to go to the Savings and Loan. The federal government regulated banks in that way. So you had 2 different types of banks. Today, you don't. They're all the same. Okay? They all do the same things. But a thrift today would be more like a credit union. Okay? And every other bank would be a commercial bank. But they all do the same things now.